Digital assets aren't just Bitcoin charts and meme coins. The real long-term story is infrastructure. The companies building the rails, the exchanges, the payments pipes, the mining hardware, and the services that power the entire ecosystem. Today, we're breaking down an ETF designed to capture that theme in one ticker, the VanEck Digital Transformation ETF, ticker DAPP. This is the ETF investor, and this one sits right at the intersection of traditional equities and the digital asset economy. DAPP tracks a market cap-weighted index of global innovative companies involved in the digitalization of the world's economy through digital assets. In plain English, it's an equity ETF that targets companies whose businesses are tied directly to digital asset activity without being limited to one country or region. What makes DAPP interesting is its pure play focus. The fund's underlying index is built from what it defines as digital asset stocks, meaning companies that derive at least 50% of their revenue from digital asset projects. That filter is important. It's meant to keep the portfolio concentrated in businesses that actually move with digital asset adoption, rather than tech companies that just happen to mention blockchain in a press release. The types of companies DAPP can include cover a wide range of the digital asset ecosystem. You'll see digital asset exchanges, payment gateways, mining companies, equipment providers, technology and service firms, infrastructure businesses that support digital assets, and even e-commerce exposure tied to this theme. The goal is not to pick one winner, but to capture the businesses that benefit when activity across the ecosystem rises. Now let's talk about how the index chooses holdings, because this matters for how the ETF behaves. Eligible companies are ranked by market capitalization, and only the top 85% of that ranked universe qualifies for inclusion. From that group, the index selects the largest 25 companies as constituents. Those holdings are then weighted by market cap, with a single security cap of 8% to avoid extreme concentration in one name. The index is reconstituted and rebalanced quarterly, which means the fund updates its exposure as market caps change and as new companies qualify or fall out of the eligibility rules. In a fast-moving theme like digital assets, quarterly updates can make a big difference in keeping the portfolio aligned with what's actually leading the space at any given time. So what does DAPP act like in a portfolio? The most important thing to understand is that DAPP is not a stable diversifier. It's a high-volatility thematic equity ETF. Even though you're buying stocks, those stocks are heavily influenced by the digital asset cycle. When crypto sentiment is strong, trading volumes rise, network activity increases, mining economics improve, and the broader ecosystem tends to benefit. When sentiment turns and activity dries up, the drawdowns can be sharp. That means DAPP can be explosive in bull markets and painful in bear markets. It is not designed to be a set-and-forget core holding for most investors. It's better thought of as a tactical or satellite allocation for investors who have a clear thesis about the growth of digital assets over time, and who can tolerate major volatility along the way. Another key point is that DAPP does not hold digital assets directly. It holds companies. That can be a positive for investors who want exposure through a traditional equity wrapper, but it also means your returns depend on corporate execution, regulation, and business models, not just the price of Bitcoin or Ethereum. Regulatory risk is a big factor here. Exchanges, payment rails, and infrastructure providers live under changing regulatory frameworks across multiple countries. A shift in enforcement, taxation, or market access rules can impact earnings and valuations even if digital asset prices are doing fine. On the flip side, clearer regulation can unlock institutional adoption and boost these businesses. There's also concentration risk. 25 holdings is not a huge number, and the theme itself is tightly correlated. Even with an 8% cap, DAPP can still behave like a concentrated bet because many companies in this space rise and fall together. So who is DAPP best for? It's best suited for investors who want equity-based exposure to the digital asset ecosystem, want a rules-based approach, and want a global portfolio of companies that are genuinely tied to digital asset revenues. It's a cleaner way to express the picks and shovels thesis in crypto without owning coins directly. Who is it not for? If you can't tolerate volatility, if you're building a conservative income portfolio, Or if you expect this to behave like a broad tech ETF, DE will surprise you. This is a thematic, high beta allocation that needs risk controls and realistic expectations. The bottom line is this. DAPP is a focused ETF that targets companies deriving at least half their revenue from digital asset projects, selecting the top market cap names and rebalancing quarterly. It's a powerful way to access the digital transformation theme through equities, but it comes with all the volatility and regulatory uncertainty that this space is known for. If you want, comment DAPP versus BITQ or DAPP versus direct Bitcoin, and I'll do a clean comparison next. And if this breakdown helped, subscribe to the ETF Investor for more ETF reality checks and strategy-first investing.